Hey there, I'm Patti Ogilvie and I'm a senior enrollment counselor with the Student Loan Help Group.
And I'm Sam Pettingill. I'm also a senior enrollment counselor with the Student Loan Help Group.
So today, Sam and I are going to go over some proposed changes for the income-driven repayment plan, as well as some other information that you guys are likely going to benefit from. And then we'll go from there. So let's just start out with the first question that most borrowers have that we've been talking to is how does the proposed income-driven repayment, you guys better known as possibly IDR, how are these changes going to impact the student borrowers? Sam, do you want to talk a little bit about that?
Absolutely. So the Department of Education has realized for a long time that it's really a strain on a lot of student borrowers. We've had income-driven repayment plans for a long time where your payment is based on your income and your household size. And one of the challenges has been that those payments don't really reflect the economic reality of families anymore. The income-driven payments can often be very high. You'll have families that are only making, say, $40,000 a year, and they might still have a payment of $200 a month, and it's just not affordable. Part of that has to do with the way that those payments are calculated based on the federal poverty line guidelines, which haven't, really been meaningfully revised in a long time. So what the Biden administration has proposed, and this is a proposed change, it is not official yet, but it will be intended to take effect later this year. If this proposed change takes effect, it will increase the amount of income that's protected from being considered as part of your income for student loan purposes. Right now, it's actually 150% of the federal poverty guidelines. They'll be upping that to 225%, meaning that more of your income is protected from even being looked at for the purposes of your student loan repayments. So anything below about a $15 hourly wage equivalent for a full-time job would not even be looked at for your student loan purposes. What that's going to do for most borrowers, so any individual borrower who makes less than roughly $30,600 annually as a gross income before taxes would have a payment of $0 a month. That will still be a qualifying payment for forgiveness programs like public service loan forgiveness or income-driven repayment forgiveness. But instead of making a monthly payment of, say, $100 a month, you'd be making a monthly payment of zero. That's going to be a huge benefit for a lot of people. If you have a family size of 4 and your family income, so either yourself if you're head of household or you and your spouse if you file jointly, if you have an income of less than about $62,400, you will also have a monthly payment of approximately zero a month. Now, if your income goes up from that, of course, you may end up having a payment that would be more than $0, but it's still going to be significantly less than what you would be seeing in terms of if you were looking at the current guidelines, it's going to make a very big difference. So, and they've also reduced. So normally with revised pay as you earn, which is the plan that they're looking at reforming, you would be paying 10% of your discretionary income. So basically they're taking the amount that you made. So say $50,000, they're subtracting the federal poverty guideline limits for your income. Let's say that's $40,000 for your income and household size. Now you're left with $10,000. If they were calculating it under the normal rules, they would be taking 10% of that $10,000 left over. So they would say $1,000 a year, divide that by 12. Now there's your income-driven payment. They're now cutting that number down from 10% to 5%. So in the example I just gave, instead of looking at $10,000 as your discretionary income, they'd now be looking at $5,000 as your discretionary income, and they'd only be taking, they'd only be taking 5% of that as opposed to 10. So instead of $1,000, they'd only look at 500 a year.
Now, looking at the opposite end of that, so you said like under the new guidelines, somebody would have a $0 a month payment. So just so somebody can compare the old payment, if nothing changes. So you use the household size of 4. Let's just use an income of 60,000, and let's just use a ballpark figure of 50,000 in student loan debt. So the new proposed payment would be $0, which would count towards an income-driven payment, even though it's 0. But the way it is set up now, that payment would be $125. So that's a huge difference.
Yep. Yeah, that's a good illustration of what I was just saying. They're going to be taking so much less of your discretionary income that for a lot of people it'll work out to $0 a month or a much more affordable payment. Using that new calculator, I've been seeing payments, where it had been something like $150 or $200 a month reduced down to 30. So it is a big change. The one thing that is a little bit different with this compared to any of the prior repayment plans is that it will now take into account what percentage of your loans are from undergraduate study versus graduate study. So if you're using any of those calculators going forward that are using the new plan, it is important to have a ballpark idea. Say you borrowed $100,000. If 20,000 of it was for undergraduate, then you need to know that 80,000 was for, or 80% was for graduate study.
Right.
That's important because that will get factored in. Graduate loans aren't given quite the same terms. They can be up to 10% of your discretionary income for graduate loans, and they'll actually take an average. So it's a little more complicated than before in terms of calculating it, but it works out hugely in the borrower's favor in pretty much all cases.
Right. Well, that's great news. Really
Yep.
great news.
One other thing to be aware of about this change is that the Department of Education will be sunsetting certain plans. If all of these proposed regulations go through, borrowers who are currently on, say, income-based repayment or income contingent repayment, ICR, will be able to stay on those plans if they're already on them, but they will not be able to join them again, with the exception of ICR, because ICR will still be available for Parent Plus loans, as it always has been.
Right.
It might make a change to your payment plan name, but it's still going to end up benefiting.
Right. I think it's going to work out better for the majority of the people, for sure.
For sure. The Department of Education has given a little bit of details about that. They've given some estimated effects. Patty, would you be able to go over those a little bit?
So a lot of the Sam already went over, but some of the effects, so future borrowers, like Sam was saying earlier, would see their total payments per dollar decreased by about 40%. And then borrowers with the lowest projected lifetime earnings would see payments that are 83% less. And this is taken right off the US Department of Education information. So while those in the top would only see a 5% reduction, and then a typical graduate of a four-year public university would save about $2,000 a year relative to the current repayee repayment plan. And then a first-year teacher with a bachelor's degree would save more than $17,000 in total payments while pursuing public service loan forgiveness, a 2/3 reduction in what they would pay in total under repayee. And again, we want to just reiterate that these are just broad examples, you guys, and each individual person's situation is going to be different, but just to give you an idea. And then also 85% of the community college borrowers would be debt-free within 10 years, which is absolutely amazing. And then can you think of anything else that you think that we should add to that, Sam?
There are a couple of other parts of this that are still being proposed that are yet to be finalized. For example, if you are making the monthly income-driven payment on your loans, let's say you come back with a $100 income-driven payment. If you're making that monthly payment every month, your interest on your loans will not increase. So, for example, if you had $200 of interest accruing on your loans every month after the CARES Act ends, and you make that $100 payment, the other $100 will not accrue and not be added to your loan balance. So as long as you keep on track with your income-driven payments, you won't be seeing those scary increases anymore if your file is handled correctly.
Right. That's great news. That's great news. And then for students who've already applied for loan forgiveness, is any of this going to impact their eligibility, Sam?
Not at all. Any of the payments that were made under any of the previous payment plans are still going to be valid as long as you were on the right payment plan for your tax filing status. With the limited waiver and the one-time account adjustment, for a lot of people, even those considerations don't matter too much right now.
Right.
It's really not going to affect people who have already applied. It will affect people who are going to apply in the future because it's going to make their overall payments much lower.
Right, right. So they're gonna come out pretty darn great, and what a great program.
For sure. And just shifting gears a little bit, Patty, we've talked a lot before about the Biden-Harris debt relief plan, the plan that everybody has pretty much heard about at this point with the $10,000 in debt relief. What clarity can you provide for people who are a little bit confused still about that plan, where it's going, where it's headed?
So a lot of people are under the assumption that the pause on the Biden-Harris administration debt relief program has put everything on pause. It has not. The only forgiveness that's on pause is the Biden-Harris debt relief. Now, I say they, it's under appeal right now. And of course, talks are supposed to start up again about that to, I guess, see how they're going to vote and how they're going to be able to hopefully get that pushed through. And that would be 10,000 in forgiveness for people who have direct loans, or 20,000 if somebody had a direct loan as well as a Pell Grant if they meet the income eligibility. Now that's still on the table and hopefully it happens. But the main thing to remember is that it does not stop the teacher loan forgiveness program or the public service loan forgiveness program or the Fresh Start. Fresh Start is another great opportunity for people who are currently in default to get out of default and back in good standing. It's a like once in a lifetime opportunity as far as I'm concerned. So that's a biggie for anybody who is in default. Anybody who has questions, what is going to affect them and not affect them, I just urge everybody to set up your phone consultation with us. We'll review all your loans and we'll tell you all your options moving forward, as if the Biden relief was going to happen, as if it's not going to happen. So we'll weigh all of your options and know which way is going to be best for you once they do work out all the I don't know what to say, all the craziness surrounding the Biden relief program. But there's nothing to really be confused about. A lot of people think that they missed the deadline for December 2022 to fill out the application. That is not true. It's actually, you're going to have a year from the time that it is approved to apply for the Biden relief. So if somebody tells you that the application was taken down and off the studentaid.gov site, now you're no longer able to fill out the form, that's not true. You can't fill it out right now, but if it passes, then you will have another opportunity to fill out that form. If you didn't fill it out, that doesn't mean you're not eligible. And then, Sam, what can borrowers expect on the road ahead?
Well, there's a bunch of important dates and important things coming up. One of the things that we need to keep our eye on is, just like you were just talking about, the Biden-Harris relief. That's going to before the Supreme Court in another week, on the 28th of February. So we know they probably won't make a decision right away, but that's going to be something that will definitely be in the news coming up here. We also have, of course, the end of the CARES Act coming up. So we've all been on the CARES Act forbearance. If you have direct student loans, you've been in forbearance since March 13th of 2020, back when the pandemic began. That forbearance is winding down now. It's going to be ended 60 days after the court cases surrounding the Biden-Harris debt relief are resolved. So if the Supreme Court makes a decision, say May 1st, that will start a 60-day countdown, and then we would all go back into repayment July 1st. If there has not been a decision made by June 30th of this year, then we'll go back into repayment 60 days after that, which would be September 1st. So right. Repayment is somewhere on the horizon. We definitely need to keep that in mind and kind of budget for that, because that's an expense we haven't had as borrowers for a long time, and it's going to be coming back at us.
Yeah. And I would urge everybody to not assume that it's going to be extended again, because they are saying absolutely it is not going to be extended again.
Yeah, I think this really is going to be the last one. The whole purpose behind this extension was to give people time, if the Biden-Harris debt relief does go through, to apply and receive that. So I don't think it's going to get extended again either. We also, of course, when that ends, that's going to start that 1-year countdown you were talking about with the end of the Fresh Start program. So for people in default, those consequences will be coming back soon of garnishment, tax offset. You really don't want to have to deal with those. So getting out of default now is very important. Of course, the implementation of what we were just talking about with the proposed income-driven repayment changes, that the what they're calling new repayee is going to be coming into effect later on this year. We don't know exactly when yet. We're also going to have coming up in the future additional changes. There's been changes proposed to public service loan forgiveness. So later on this year, there are some changes that might affect certain borrowers. For example, if you've been working for a organization that's qualifying, a public service organization, and you haven't been considered full-time by your employer, starting later this year, 30 hours a week will become the new threshold. So it will no longer matter if your employer considers you part-time. For example, substitute teachers who often work 40 hours a week but aren't considered full-time by their employer, they will now be eligible. And that, according to the Department of Education, is going to be retroactive too.
Oh, so that's great.
Yeah, that's going to be huge for a lot of people who maybe, applied back in 2010 or something and were denied based on not being considered full-time.
Right.
Be able to resubmit. They will not, according to what they've said, they will not be reconsidering the old employment certification forms, a new one would have to be filed, but they will consider it again based on the new rules.
Mhm. And then, of course, we got the May 1st date on the horizon too.
Yep. Yep,
And
that's
so,
another one that if you're looking at the one-time account adjustment, you don't want to miss.
right. And so you guys, this is literally the last chance to get any of your old payments that normally wouldn't count to count. So do not delay. Like, it was crazy when the original waiver was expiring on October 31st. Do not leave this to chance, you guys, because it's not the DOE's responsibility that you make these deadlines. It's yours. If we're doing the work for you, it's ours. So again, if you're not sure which way to go, just reach out to us, let us do the consultation, and we'll know exactly what options you have. Because there are a lot, and admittedly, it's confusing. But we know what we're doing, and we're experts at it. So definitely take advantage of the fact that the phone consultation is completely complimentary.
Yeah, I can't stress enough, don't wait until the last day or something like that if you're planning on taking advantage of that May 1st deadline. We saw that with October 31st. I mean, they crashed the site multiple times for studentaid.gov. So don't count on the fact that you will be able to get in at the last minute and get everything done, because you may.
Because there was a period where that site was down for a majority of the day for many days. So definitely don't leave it to chance. And then Sam, like, where should people go to get updates on this information through the Department of Education?
Well, there is an announcement section on studentaid.gov that gets updated every time something new happens or is released. Of course, you can always take a look at our website as well at TSLHG.com. We have a lot of those same updates that are being communicated on there. And you can always have a consultation with us. We'll be able to keep you up to date on what's been going on most recently, and what your future might hold as far as forgiveness.
Absolutely. So do you have anything else that you want to add, Sam?
I don't think so. I think we've pretty much covered everything. Do you have anything else, Patty?
Oh, yes, I do. Spousal consolidations, you guys.
Good
The
point.
DOE is working on a way to separate those. Up until now, if you've had a spousal consolidation, they don't even do these anymore, but a lot of you have these from years ago. They are going to provide a process to separate those, which will now make each of you spouses, husband, wife, each eligible for whichever federal forgiveness program that you're eligible to work toward. Right now, the way it stands with spousal consolidations, you have no federal forgiveness options. So this is huge. They have not made that announcement as to what procedure has to be done to separate them, but it is coming, they say. So that's a biggie.
Yep. And we'll keep up to date on that as well. If that's something that affects you, definitely reach out to us. We have an update list going of people who will be affected once we are able to move forward with those separations.
Absolutely. Well, as always, thanks for watching our information, our videos, and next time we'll give you some more great information. Take care, y'all.
Take care. Have a great one.